Good morning. Welcome everyone to this Landmark Property Trends webinar. Thank you very much for joining. Today we're going to be talking through some key data and themes from last year, and also a quick chat about what we think the future might have in store in 2025. We've got some slides and some data to go through, and then at the back end of the webinar we've got a poll for some interaction to see what you guys are thinking, and then we've got time for some questions at the end. So without further ado, I shall get cracking. I'm joined by four of my colleagues here. I shall introduce them one by one in order on the screen. First off is me, Mike Holden. I am a Divisional Director at Landmark, so I've worked here for 12 years across multiple business streams in the company. I'm joined by Ben Robinson. Ben is Managing Director of our Estate Agency Services business. Welcome, Ben.
Morning, Mike.
And then Rob Gurney. Rob is Managing Director of Ocrasoft, which is our conveyancing case management system. Morning, Rob.
Hi there.
And then Richard Hepburn. Richard is Managing Director of Landmark Scotland, so joining us from north of the border. Morning, Richard. And finally, Graham Edwards. Graham is Managing Director of Landmark Valuation Services, so working with mortgage lenders and surveyors. Morning, Graham.
Morning.
So if we move on to the first data slide. So this comes from our property trends report. This slide is showing 4 key milestones in the residential property transaction. These are measured against the equivalent month in 2019. So where the line is at 100%, that means we saw the same amount of activity as 2019 for that month. And we talk through here from left to right. We run through the property transaction, which is listing, sold subject to contract, searches ordered, and then completions. So first up, I'll pass to Ben. Ben, from an estate agency side, what's the summary of this data from 2024?
I think it's pretty stark to show that supply is in a good place and perhaps demand's still not where we'd like it to be. Agents always tend to focus in on getting new listings, and new listings are strong, both on 2019 actually. I think about 6% up on 2019, 8% in the final quarter, so that was a slightly improving position, and up year on year, and often it's the year on year feel that creates positivity. What isn't necessarily materializing like it did back in 2019 are sales and the throughput of that, which is obviously where people and agents get, for the most part, get paid. So that has still been a challenge, albeit again they tended to be in a more positive position year on year, and again that's a more recent comparable, so there's quite a lot of positivity in that front as well. There does seem to be a lot going into the pipe, but perhaps not as much as would be anticipated in those circumstances coming out. And I think what we've also seen is a bit of a shift in dynamics for agents to manage. Post-COVID was very much a seller's market, 10 buyers to every property, everything you put on sold, and it's reversed pretty quickly. We've got record amounts of available stock, and now you've got a buyer's market. They've got choice, and perhaps that explains a little bit about why we're not seeing the flow through from increased listings into increased completions, because people can take the time, they can be fussier, more choosy, they've got more choice at the end of the day.
And Rob, passing on to you from the conveyancer side, so the kind of the right hand side of these bars, what have we seen from a conveyancer's point of view?
Yeah, thanks, Mike. It looks pretty bleak when this slide suggests that across the quarter of quarter 4 of last year, completions appear to be roughly 37% down on the same quarter of 2019. But I think that's probably the key sort of thing to say really is, we are talking about 6 years ago. And actually, if we put the same graph up and compared 2024 to 2023, then actually, we would be sort of way over 100%. It would be 107% of 2023 levels. So yes, we do talk about 2019 being the last sort of normal year before COVID, but because it's now 6 years on, it sort of does paint a sort of quite a dark picture in terms of where we are in terms of completion numbers across the industry. But as I say, year on year, it's actually up from the previous year. Does beg the question, doesn't it? Is there such a thing as a normal year anymore? Possibly not. But in any event, that's where we are. And when you start thinking about the quarter ahead that we're currently in, quarter one of 25, then of course the SDLT deadline, of course, is affecting everything in conveyancing land at the moment. I do anticipate, and we can already see actually sort of looking mid-month in January, that there is already an upwards trajectory, as you'd expect in that kind of stampede towards the end of quarter one, where the stamp duty changes take effect. Of course, the opposite will happen after that sort of cliff edge. We'll have a huge surge up until the end of March, and then of course there'll be a drop off as expected in April. So yeah, that looking ahead, just things are very sort of chaotic, aren't they, in the property market, and there's no sign of that sort of changing in the next 3 months.
Thanks, Rob. It's an interesting point you make around the stamp duty changes. I'm going to throw back to you, Ben. What do you think that means for estate agents right now? What do you think the impact of those changes is on that market?
I think ultimately, if we look back at the last stamp duty changes, had a wider impact, but it's not going to be dissimilar in terms of the stress levels for all property professionals in there. People are going to want to move. They're not going to want to pay the extra. If they do end up being in that position, there's going to be negotiation. And we're already seeing with particularly large pipelines actually going through a lot of pipeline management, taking up a lot of time. Things not coming through efficiently as they would like to. So I envisage that for the first quarter, and then obviously afterwards, the fallout from that, which is again the people who didn't quite make the grade. There could be renegotiation, refinancing, and probably just to mention as well, off the back of sort of Rob's comments coming into the year, our sort of live numbers show that the patterns remain pretty steady in terms of supply is strong and sales are not as strong as we would like them to be. It does, however, say, at the end of the day, an increase in supply is a suggestion of demand, because that's people wanting to move. People do want to move. So it does suggest that perhaps if we can align some stability in the affordability and around interest rates against the price of properties, and we've seen quite a lot of price correction actually in the back half of last year, there could be a bit of a rush for agents, so that would be great news, of course, but there's always then the management and capacity issue of the industry alongside the stamp duty changes that will be putting pressure on. So I envisage it's actually going to be quite a busy spring with lots of pipeline management involved.
Thanks, Ben. That's a really interesting point, and looking forward to later on in this session. Our attendee poll is going to get our attendance view on that point, on impact of stamp duty versus interest rates. What are people's view on that? So it'd be interesting to see what our guests see. If we just moving on to the next slide to look at the valuations market. So this is mortgage valuations. This is taken from Graham's business, and each one of these lines represents a different year, and you can see that on the right hand side. And this is showing adjusted for the number of trading days, so daily working day average, the number of mortgage valuations we've seen per week within the year. So as you flow from left to right, we're moving through the year, and each one of those years, each one of those lines represents a different year. So you can see starkly there, the dark blue line there is for is 2020. You can see the impact of the COVID lockdowns kind of slowing the market down. But I shall pass on to you, Graham, to kind of talk through this and really relation to, I guess, 2024. What did we see in 24, and certainly towards the end of 2024? What have we seen in that world?
Yeah, thanks, Mike. We definitely saw a more positive picture in Q4 last year. If we look at the overall year, 24 versus 23, completed valuations were only up by 2%. But if we look at Q4 24 versus 2023, we saw, not on this chart, but we saw instructions increase by 22% year on year, and completed valuations, which is what this chart shows, they increased by 27%. So we saw a very positive end to the calendar year when it comes to completed valuations. There's probably, to my mind, maybe 3 reasons for that, which also maybe gives us an indicator of how the market's going to play out for the rest of this, or certainly the immediate term in this calendar year. I think certainly in the second half of 2024, we saw a number of rate reductions, albeit when you look at the sort of lender rates as a whole across the market, they were fairly marginal, but there were some good deals to be had out there during the last 6 months of the last calendar year. The problem with those were they weren't available for very long, and that had sort of different impacts as a result of that. Secondly, and I think maybe more significantly, Mike, I think we've started to see affordability improve over the second half of last year. Since March last year, we've seen inflation drop significantly, albeit in the last couple of months it's ticked up a little bit. But we've also seen wage inflation rising slightly, especially in the public sector, I would say. And I think for many people now, affordability has improved, and that low inflation is probably resulted in a little bit more money in people's pockets. That's started to flow through a bit now. And then the final point I think I'd make, this is maybe a little bit subjective, but I'd venture to suggest there's maybe been a bit more of a normalization effect that we're seeing now. So we know that the very low mortgage rates that we've seen in previous years, sub 3% or even sub 4%, I don't think they're going to come back anytime soon. And I think we're probably seeing what I would call a new normal now when it comes to purchasing. Purchasers are getting more accustomed to those rate levels now, and I think that they're not holding off moving any longer, and they're just going for it.
Thanks, Graham. That's really interesting, really useful. Thank you. We did have a question that come in, which I think is related to that. So I shall just pose that to you now, which is the question is what the expectations for interest rate cuts and what might the impact for that be on residential sales. I think if I give my view on that first, and then Graham will pass over to you and the rest of the guys. I mean, there's varying forecasts in terms of how many base rate cuts there might be throughout the year. I think there was one prediction I saw in the trade press this morning of 6 cuts.
Yeah.
I think actually probably the bigger factor in terms of the market is mortgage rates over Bank of England base rates, and they don't always follow hand in hand. So we've seen base rate fall over last year, but we see if I went to the market now for a mortgage, I'd be getting a higher rate than if I went at this point last year, because we saw low mortgage rates over Christmas period, 23 going into 24. So I think the bigger factor is swap rates, so the price that banks borrow money at, and then that impacts the price that they can lend, the rates that they can lend to the general public at. When those rates are lower, mortgage rates are lower, we'll see more activity. I don't know if you've got anything to add to that or challenge on that, Graham, or anyone else on the panel?
No, I think I'd agree with that. I think swap rates would definitely need to keep an eye on, Mike. When I checked this morning, they opened at 4.3%, and that's been pretty consistent over the last few weeks. So I think that I think they were sub 4% prior to the Reeves budget. So I think we just need to keep an eye on that. I think the other thing I'd say about Bank of England base rates is there is pressure to reduce base rates, and that's because of the situation we find ourselves in with the UK economy. We know there's very, very little growth, if any at all, in the UK economy right now, and I think there's pressure to reduce base rates to try and stimulate some growth in the economy. So we'll see what happens. It's very difficult to predict. None of us are financial analysts on here, but I think I would agree with what you said there.
Great, thanks, Graham. I think if we move on to the next slide, Richard's been sat there patiently in Edinburgh. So Richard, this is similar to our first slide that we saw. So showing the milestones for 4 key elements of the transaction relative to the same month in 2019, and this is data taken in Scotland as opposed to in England and Wales. So it looks pretty different as a chart. Richard, do you want to talk us through this?
I can, Mike. Hi everyone. Yeah, I mean, I think you can see, as Mike says, the chart is a bit different, and it's certainly been a much more buoyant market up here compared with that 2019 level, and also to relate to what Rob said against last year as well. So listings pretty healthy, similar to what Ben said, probably marginally level to 2019, but the difference really is the number of listings that are progressing through the whole stage to completion. And definitely we've also seen a bit of an uplift in the last quarter of the year, probably linked to what Graham said in this sort of mortgage rate stabilisation and post-election. So the question I'm always asked by my colleagues in Landmark whenever we look at the slides is why the difference? Why Scotland performing a bit differently? And I think we've probably covered some of these in previous discussions, but it's worth just reminding everybody of some of them. I think some of them are just economic structure. I mean, the average house price in Scotland's about 195k, whereas it's 306k in England, and on top of that, you then got a set of property taxes that are devolved from Westminster, the Scottish Government. So land and buildings transaction tax here just operates to a different regime. It's got different levels of first-time buyer relief. We don't actually have a change coming up this spring, even though the Scottish Government are starting a review. So immediately that's going to create a different mix of factors in terms of property value, affordability mix, which may be part of the story. I think the other things are probably more structural in terms of market structure. I think some of you will be aware that in Scotland 2/3 of sales go through pure estate agents, a third go through solicitor estate agents, where you've got estate agency and conveyancing under one roof, so shorter lines of communication. We have the home report, the RICS sort of EPC valuation survey and seller questionnaire wrapped up in a document mandated as being available within 2 weeks of the property listing. So that already goes a long way to meeting the new National Trading Standards material information requirements. And what that does, even at an early stage in the transaction, is filters out potential purchasers who just might find out something about the property that puts them off. And it also means that they can have a slightly more focused dialogue at viewings, potentially, if they've chosen to interrogate the home report. A key thing we've been discussing recently in Landmark as well is the fact that a marketing fee is charged up front by estate agents in Scotland. That immediately, I think, creates a sort of commitment particularly from the sellers to the transaction, and that's clearly a factor. Solicitors, conveyancers are involved early in the process, both around the bidding stage, setting closing dates, running a sealed bid process, and even on the buying side, you get a solicitor to help you decide how much to bid, potentially over the asking price, and basically coordinate evidence of readiness to proceed. So that's all under Law Society guidance. So I think even at that stage, again, there's a sort of mindset of motivation and committed sellers and buyers. And then beyond that, which we'll probably come on to in later slides for England, there's just differences in the conveyancing stage. So transparency of information early. We've got standard sale and purchase contracts, standard missives. That's now on its 5th edition. It gets regularly refreshed to take into account new issues emerging in conveyancing. Basically that just reduces inquiries. Searches are available typically in 24 hours. All the Scottish local authorities are information's available online. So I think you take all these factors together, and that's probably the reason for a more confident market, even though some of the underlying economic factors and drivers of affordability. There are chains, there's late stage affordability issues here where people fall through, but fall throughs are still probably 3 to 4 times less. So I think that just is because all these other factors in the market are combining to just give people more confidence that transactions can proceed. Looking forward into FY25, I think there are some signs you can see even on this chart. Listings possibly did start to drop off a little bit at the end of sort of November, December compared with earlier in the year, and perhaps our early signs in January is that some of those upfront issues or upfront matters might be starting to show a sign of tailing off, but it's probably too early because January is such a volatile month. So that's it, Mike.
Thanks very much, Richard. Really interesting. I also think it will be interesting to see next quarter, without there being any stamp duty change in coming up in Scotland, what the kind of relative stats look like when we look at quarter one. If we are going to see a flurry of activity in England and Wales pre stamp duty window being shut, how's that going to look? So I'm intrigued to see what that looks like, and also yeah, lots of interesting stuff there about the difference in the transaction, the impact that makes. I will come back to you later on in the session when we talk through some of the transaction timescales, because it'd be interesting to get your view on that and how that differs in Scotland. Just one kind of relevant question on this bit before we move on, which is has come through as pros and cons of using 2019 as our baseline for year for comparison. That is a really interesting question, and one we've posed to ourselves internally. The short answer is we've used 2019 ever since we've been doing this trends report. So this is the fourth final year of it, and that's really because when we've looked at it, we've not really seen a normal year since then. 2020, obviously, there's the impact of COVID. So comparing 21 to 20. Was tricky, and then we had the stamp duty, the post-COVID flurry, stamp duty windows, etc., and then the impact of the mini budget. So our kind of view is that 2019 is the last normal year. We will be reviewing what year we compare to. Now we're starting afresh as 2025 as a new year. I think as I think it was Rob mentioned, we're kind of probably in a new normal now. So it might well be that we look at year on year in future. Obviously, any feedback from any of you guys, please follow up, put it in the chat. It would be really useful for to find out what's useful for for the market in terms of a comparison. Now moving on to the next slides, we're now moving on to our milestone data. So there's a milestone report that Landmark publish every year where we look at ultimately how long it takes to buy and sell a residential property. This milestone data is taken from the IntelliWorks conveyancing workflow tool, which Rob is our expert in, and as you can see, we track that back to 2007, and we're looking at the number of days it takes to step through certain milestones in the process. So Rob, can I pass on to you to talk through this?
Yep, sure. Thank you, Mike. And yeah, conscious of time, so I'll stick to sort of headlines only. I know all of these slides will be available to everyone afterwards anyway. Effectively, yeah, on the sale slide, we're looking at the lines here showing from instruction to completion, from instruction to exchange. And then the bottom line is the time it takes from contracts to be issued to receipt of inquiries from the other side. So, I mean, the only thing to sort of take away from the first two lines, which are the instruction and completion lines, is clearly, the upward trend. And you can see that from 23 to 24, that trend has sort of eased off, but is still increasing. That's really important when we start looking at the purchase slide next. The one thing I would say in terms of the inquiries, you can see reasonably sort of stable length of time in terms of issuing the contracts to getting the inquiries back from the other side. It has sort of steadily increased up until 22. There was a drop off last year, but actually sort of a tick back up in 2024. So what we're saying here is when we first started looking at these statistics, it took roughly about 20 days for the other side's lawyer to, let's say, check the contract papers and raise the necessary inquiries. And actually, in 2024, that was up to 30 days. So actually, we've seen about a 50% increase in that sort of turnaround time between receipt of papers and raising inquiries. So yeah, something to sort of keep an eye on there. Again, it's interesting to compare when we get to the next slide, which has a few more lines on it. So if we can flip across to property purchases. There we go. There's 5 lines here, so quickly just to explain. The top 2 are very similar to the sale chart that you've just seen, which shows on average the time it takes to get from instruction to completion and instruction to exchange. Again, you can see those 2 lines mirroring each other as you'd expect. The crucial thing here to look at is the last 2 years. So from 22 to 23 and then 24, those numbers have come down. So the average time it takes on a purchase transaction has in the last 2 years decreased. So wait just a second, we'll get back to that point because it's quite an interesting one. But just to go further down the chart, the light blue line is from case instruction to the receipt of the mortgage offer. And you can see there's sort of a very, very gradual increase from 23 to 24. I think it's 1 day extra. Yeah. So we won't worry too much about that one. The next one down, which is the orange line, is actually quite something that's close to my heart. It represents the inquiries process. So it's basically an average time from when the inquiries are raised to when all of them have been replied to and that inquiry process has come to an end. The good news is, as you can see, from 23 to 24, there's a drop-off, which is fantastic. It means that, I think it's fair to say 2024 was the first year that the profession actually acknowledged the inquiries process was, a fundamental issue in terms of transaction timescales. And it does look like, additional focus has led to a very welcome drop-off in the time it takes. But before we sort of, start doing cartwheels about this, I think it is also important to point out that we actually only have, reduced that back down to where we were around about 2020, 2021 in terms of time levels. And actually, we are still exactly double the time that it used to take, way back in 2007 when we first started monitoring this. So, still clearly a lot of work to be done in terms of, shortening that inquiries process. The bottom line on this chart, so a really interesting one. It's one that if you've heard me talk about these in previous years, it's about exposing the myth of search delays within conveyancing transactions. And as you can see, the number has dropped, quite significantly to the point where, at a point where it's roughly 10 days between searches ordered and searches received. Now, obviously, we know this is an average. Some local authorities take a lot longer than others, so there'll always be sort of outliers. But the myth to sort of, to continue to sort of keep busting is that as long as the searches are ordered at the appropriate time in the transaction, they should not be the cause for any transactional delays. And that's something that some people, do find quite interesting. So going back to the timescale piece, what's really interesting is comparing the sale length and the purchase length in, say, the beginning of the comparison in 2007 and where we ended up at the end of 2024, because what you see is there's a difference between the purchase length in 2007 and the sale length in 2007 of 10 days. So quite a narrow sort of window between how long it takes to sell and how long it takes to buy. And that would suggest that the seller's lawyer and the buyer's lawyer were being instructed very much more often at the same time. Now fast forward to 2024, And actually, that differential is now 40 days. There are now 40 more days from sale instruction to completion than there are purchase. And that suggests to me that there's a shift happening here. And obviously, the fact that the purchase transaction times are sort of reducing in the last couple of years, whereas in the previous slide we saw that the sale transaction times were not, is quite it's quite an interesting topic. And for me, it suggests that perhaps the industry is embracing this kind of concept of the earlier in a transaction you instruct the seller's lawyer, the faster the subsequent conveyancing process is. So that's just a theory, but we're now 2 years into that theory, and the outlook looks quite good, really. It'd be very interesting to get Ben's views, particularly on this point. Is upfront information and instructing the seller's lawyer earlier in a transaction actually having a positive impact on the length of time it takes for the purchaser's lawyer to get to completion?
Yeah, thanks, Rob. Yeah,
to you, Ben.
I think, listen, it's going to have a positive impact. It makes sense. I think everyone's talking about it, and it does suggest from these numbers that more and more people are doing it. I think when our message to the market is do it more often, or my message to the market is, I think agents can often get really obsessed with the vanity of listings. So we need to be the market leader in properties we take on. We've got the Rightmove graph that shows we take on more than everyone else, but actually that doesn't mean money in most cases. Agents are paid in completion, and actually if there's more focus on yield, then it's all bottom line. So if you can increase your certainty, and obviously speed generally leads to more certainty of your pipeline, like in any sales unit, you'll actually get more out for the same amount of effort. So I think agents are more and more realizing that, especially in a world where there's increased competition. It's easier to open an agent than it used to be, because you don't need a high street office with lots of staff. There's lots of networks that you can join. I think it's harder to take market share than it used to be. It also generally means if you get more work done at the start, you've got a more committed seller. They're willing to put that effort in, and if there's any cost attached to that, pay that. They tend to be committed through to move. They're not just looking to see and test the market, which in a world where finance is expensive doesn't really work, because prices have to be sharp to sell. So I think it's definitely been a major area of focus given where the market's been. I hope it continues to be. Looking forward, those trailblazers that make it work are shouting from the rooftops of the performance they're getting out of the pipeline from doing that. And of course, we've got the material information guidance, which we're told is going to be more effectively enforced this year, after having sort of a honeymoon period. And that goes hand in hand. Why not do it once well and share it? If you do it once well and share it, improves the transaction. Of course, it's a much better customer journey, consumer journey, as well as ticking the boxes for material information and bringing that solicitor in nearer the start. So it does seem to be, as you say, Rob, from your numbers, showing that it's happening. It could be certainly already having an impact, which is great. And I think if we make it a major area of focus for agents, success will come from it. So fingers crossed it continues.
Thanks very much, Ben. Just a bit of housekeeping for our attendees. I've seen there's a hand raised. We, with this tool, can't interact audibly through people dialed in, but if you have any comments or questions, please pop them in the chat or the question section, and we'll be able to read them out. There are a couple of questions come in. This is, I think, a pretty relevant one, Rob, on this. This is around the average inquiries raised to receive. The question is this more down to conveyancers taking longer to raise or delays in responding?
So from on the sale graph, we showed that there was a slight sort of increase in the time it takes for the inquiries to be raised. Obviously, there could be a number of reasons for that, not necessarily just that there's stockpile of packs to check. So it's interesting that does seem to have gone up in the last year. But in terms of the question, in terms of the process itself, the fact that the inquiries that once they have been raised are being resolved slightly quicker is obviously a good sign, and suggests that more focus is being put on this area of conveyancing. So yeah, I guess it's kind of, on the one hand, there's been an increase in terms of when those inquiries are generated, but actually once they are generated, it looks like we're doing a better job of getting them answered quicker.
Cool. Thanks, Rob. One more on this has just come in, which is, I think is related, because you touched on the inquiries process earlier, talked about it earlier. So the question is that, given that the transaction volumes are lower now, but we've seen an increase in transaction times, or certainly prior to 2022, what do you think the factors that are causing that are?
Yeah. Well, let's not forget, and this is something that we haven't yet talked about, and I could probably talk for the next hour, and I won't, I promise, about, but the topic of scope creep, the conveyancing responsibilities versus, and it's not something that we can show on a chart, but from 2007 to now, I mean, the role of the conveyancer has changed dramatically. I think we did a piece of work a year or two ago, didn't we, that suggested that actually there's double the number of things that a conveyancer needs to do on a transaction than there were, say, 15 years ago. So, by definition, for me, everything else being equal, we should be expecting the timeframes to have doubled if the number of responsibilities and things to do has doubled. Yes, you've got the market activity. Yes, you've got resourcing differentials, and yes, you've got sort of technology helping us along the way, etc. So lots of moving parts here. But actually, I think the biggest and probably least talked about aspect of why transactions take longer than they used to is the number of things that have been dumped on a conveyancer that they didn't used to have to do.
Yeah, that's really interesting. Thanks, Rob. Just one more question for you, Richard, on this area, which is how would Scotland look differently? How would this chart look if we were to show this in Scotland?
Okay, Mike. I mean, I think you're normally looking at around maybe 8 to 10 weeks for the conveyancing, from instruction to completion. But as I said, the lawyers can be instructed much earlier in Scotland because they can be involved, on the sales side. They're involved even in the coordination of receiving the bids in for the property. So probably doing a direct comparison is difficult. But I mean, I think overall we would see from listing to completion, you're probably looking at around maybe 90 days, something like that, 90 to 100 days. In central Edinburgh, you can list to offer received can be around 20 days, maybe out in the regions might double that or a bit more, or so we've got same regional variations, but the process once it gets going is pretty quick, so for all the reasons I talked about earlier.
Thanks, Richard. So we will move on. We've got a poll for a bit of audience participation, so don't mind popping that up, guys. So it's just one question, and asking you guys, what do you think the biggest impact or will have the biggest impact on the market in 2025? So we talked about the stamp duty window closing, a surge of activity before that, a lull after it. Will it be that? Will it be, there's been lots of talk about the homes building target and 1.5 million homes being built. Will that happen? If it does, will it have what the impact on the market will be? And the third one down is, and these all kind of linked, in inflation, interest rates, and the wider economy. So the question earlier about what's going to happen with interest rates, inflation is going to have an impact on mortgage rates. The next one down, potential relaxation of mortgage rules. So there's been a bit recent in the last few days in the trade press about potentially relaxing some of the strict rules that came about post credit crunch around affordability checks, income multiples, all of those things that meant more hoops to run through. Stricter mortgage rules. Will they make a difference? And then if there's anything we've missed, please click other. Let us know in the chat all the questions. So while that was a minute or so left on that poll, I'm just going to pick up on a couple of questions on the same point that have come around the transaction times, Rob, and around inquiries. And actually, Ben, your view on this would be really interesting too. Two have come through about material information. You know, would material information being provided upfront mean inquiries can happen quicker or earlier? And you know, what do we think that impact of material information will be on transactions? I'm going to go to Ben first on this one because I think it's it's probably estate agents driving or being driven into material information.
Yeah, and exactly, and it comes back to the point I made earlier. With a focus on yield, when you've got a smaller piece of a smaller pie, more agents, less transactions, is really important. So I think the first step to that, it having a positive effect, is to embrace it positively. And actually, if you can bring a solicitor in at the start to help you with that, it means you're going to have data that's collected that then can be trusted, because it's only going to have an impact. Of course, having more data sooner is great, and if you have all the answers for when a purchaser comes into the transaction, there's not going to be any inquiries in theory because they've got the answers. But can they trust that data? And to trust that data, you've got to be able to transact on it, and that means a solicitor's got to trust the data, and likely it's got to have been sent across from one lawyer to another for that purchaser's lawyer to be able to accept it as well. So I think the quality of it's really important, and I think that's why you've got to get a solicitor involved at the start. Data from the right sources, tick the boxes for compliance, yes, but in a positive manner. Make sure the home mover really knows that by getting involved in this and doing it right once well, they're not going to have to do it again, and it's going to significantly speed up. And just branching out a little bit there to Richard in Scotland, that's what happens. I think, Richard, you said maybe 8 weeks from sort of that point of offer accepted to completion, and I think it's only a few weeks to exchange, and that's certainty. That's what people want. Once they can exchange, they can organize their life and move on. We don't have millions of milestones, and I think that's where they'd like to get to. So it makes sense. It makes sense for agents to embrace it positively. I know that's extra work at the start, which can put them off, but it really is going to pay dividends. And I think for agents, then they've got to try and make that tangible in their world, as in, if I can increase certainty 10%, what does that mean to the bottom line? That can focus the mind to put the resource where it's needed. But yeah, from an agent's view, I think absolutely, just got to be done right.
Great, thanks, Ben. Rob, from a conveyancer's point of view, material information, the impact.
Sure. I mean, obviously, there is a difference between inquiries and material information, of course. But it's been said, hasn't it, that 75% of all additional inquiries are deemed or labelled unnecessary, i.e., it's just chasing for missing information or missing data or missing documents, etc. And a lot of that stuff can be picked up very early in the process, and whether that be collected by the estate agent or by the seller's lawyer being instructed at the point of listing rather than at the point of sale agreed. So I think the collection of material information gives us the opportunity to eradicate a lot of the unnecessary additional inquiries that we know will be raised if we don't supply this stuff to the other side's lawyer with the contract pack. So I think there is definitely a link there. And therefore, the more material information becomes commonplace, I think we'll find a corresponding drop-off in the number of additional inquiries being raised.
Great, thanks, Rob. My timer at the top says we've got 90 seconds to go, so I think I'll just go back to the poll results. So the outright winner on that 72% was the interest rates, inflation, wider economy. So I think that touches on what Graham and Ben said about kind of sentiment, affordability, people's, I guess, ability to buy and to borrow. I've had one other come through, which is the renters' right bill. Now, from a sale and purchase point of view, my suspicion is that's around potentially landlords choosing to leave the market. So what would that do in terms of stock, supply and demand levels? I don't know, Ben, in the last kind of 45 seconds, any views on that?
Yeah, I think it's a big worry, but it's alongside a lot of things that have been hitting landlords for a while. And I think most agents will have seen their managed stock of lettings deplete. That means there's less to rent. So there's less choice, but actually it usually means they've been put for sale. So in theory, there's more choice for the buyer. So perhaps more tenants will move back towards sales, which was, has shifted in balance since actually the 2008 crash. It used to be a lot more people buying than than renting, and it's balanced itself out. It may go the other way a little bit. Well, let's see.
Fantastic. Thank you very much. And the timer comes to an end. I've just got 5 seconds to remind everyone that they can access these reports in the attachments at the top, and we'll email them out to all attendees afterwards. And we've reached 0, so if people are still there, I just want to say thank you so much for dialing in and listening. Hope you found it useful. Look forward to the next time. Thank you so much.